Thank you. Jonathan Schiff, visiting from Macau, China. You briefly touched upon this, but on our side of the world, there's a lot of discussion about the US dollar status as the world's reserve currency. Sorry, there's some feedback, it's kind of weird. What would be the effect upon the US and the world economy if the dollar loses that status as a world reserve currency?
Well, I don't know the answer to that, but I fortunately don't think it's going to be relevant. I think the dollar will be the world's reserve currency for some decades to come. I think China and the United States will be the two super economic powers, but I don't see any. I think it's extremely unlikely that any currency supplants the US dollar as the world reserve currency for many decades, if ever. Charlie?
Well, there are advantages to a country that has the reserve currency, and if you lose that, you lose some advantage. England had a better hand when it had the reserve currency of the world than it had later when the United States had the. It's in the nature of things that sooner or later every great leader is no longer the leader. Over the long run, as Keynes said, we're all dead, and over the long run.
This is the cheery part of the section.
Well, if you stop to think about it, every great leading civilization of the past passed the baton.
See, what do you think the probabilities are that the US dollar will not be the reserve currency 20 years from now?
Oh, I think it'll still be the reserve currency of the world 20 years from now. But that doesn't mean that it's forever.
My name is Benjamin. I'm from Appleton, Wisconsin, and I had a question for you regarding unregulated digital currency such as Bitcoin. I was wondering what you think the significance of something like that showing up in the last few years is, and what you think that might mean for the future. Thank you.
Charlie, I hope you know something about this subject, because I don't know a thing.
I know what he's talking about.
I know what he's talking about, but I just don't know.
I have no confidence whatsoever in Bitcoin being any kind of a big universal currency.
That would certainly be my gut reaction, but I haven't really looked into it. But I'll put it this way: of our 49 billion, we haven't moved any to Bitcoin. Well, the truth is I don't know anything about it. That doesn't always stop me from talking about things, but it will in this case. Okay, Andrew?
This question comes from Mark Troutman of Crested Butte, Colorado. And you've touched on this, Warren and Charlie, on little fringes today, but this is a direct question. Warren, both you and Charlie have described over the years how you have built Berkshire Hathaway to be sustainable for the long term. I am having difficulty explaining to my 13-year-old daughter, and frankly to many adults also, in easy-to-understand terms, Berkshire's business model and long-term sustainable competitive advantage. Can you give all of us, and particularly my daughter Katie, who is here today, the Peter Lynch 2-minute monologue explaining the business of Berkshire Hathaway and its merits as a long-term investment for future decades?
Okay, Charlie, you talk to Katie. I'm going to have some fudge.
All right. I'll try that. We've always tried to stay sane, and other people, a lot of them, like to go crazy. That's a competitive advantage. Number two, as we've gotten bigger, we've used this sort of golden rule that we want to treat the subsidiaries the way we would want to be treated if we were in the subsidiaries. And that, again, is a very rare attitude in corporate America, and it causes people to come to us who don't want to come to anybody else. That is a long-term competitive advantage. We've tried to be a good partner to people who come to us and need a partner with more money. That is a competitive advantage. And so we are leaving behind a field that's very competitive and getting into a place where we're more unusual. This was a very good idea. I wish we'd done it on purpose.
A few years ago, a person who's in this audience, I believe, came to me, and he was in his 60s, and he said that for about a year he'd been thinking about selling his business, and the reason he'd been thinking about it was not because he wanted to retire, and we very seldom buy business from people who want to retire. He didn't want to retire at all. He loved what he was doing, but he had an experience in buying a business a few years earlier from a family where he had known the fellow who had built it. The fellow had died, and then just everything bad started happening in the family, in the business, in the employees, everything else. So he really wanted to put to bed the question of what happened with his business. It wasn't that he really cared a lot about monetizing it or having the money. He wanted to put his mind at ease that what he'd spent lovingly building up over 30 or 40 years was not going to get destroyed, or that his family would get destroyed if he died. So he said he thought about it a year, and he thought about it, and he thought, well, if I sell it to one of my competitors, and they would be a logical buyer. They usually are. That's why we have antitrust laws. If he sold it to a competitor, they would come in, and basically they would put their people in charge. They would have all these ideas about synergy, and synergy would mean that the people that had helped him build the business over 30 years would all get sacked, and that the acquiring company would come in like Attila the Hun and be the conquering people, and he just didn't want to do that to the people that had helped him over the years. And then he thought he might sell it to some private equity firm, and he figured that if he sold it to them, they'd load it up with debt, which he didn't like, and then they'd resell it later on, and then so he would again have lost control. They might do the same thing that he didn't want to have happen in the first place in terms of selling it to a competitor or whatever it might be. So when he came to me, he described this, and he said, it really isn't because you're so attractive, but he says you're the only guy left standing. I mean, you're not a competitor, you're not a private equity firm, and I know I will get a permanent home with Berkshire, and that the people that have stayed with me over the years will continue to get opportunities, and they will continue to work for me, and I'll get to keep doing what I love doing, and I won't have to worry about what will happen if something happens to me tonight. Well, that company's turned out to be a wonderful acquisition for Berkshire, and our competitive advantage is we had no competitors. And I think, well, we will see more of that. We've seen a lot of it over the years. We'll see more of it. Charlie, any? And I don't think you mentioned the fact of developing a shareholder base too. That's different than we do look at shareholders as partners, and it's not something that a public relations firm wrote for us or anything of the sort. We want you to get the same result we get, and we try to demonstrate that in every way we can.
Hi, my name is Alex, and I'm from Los Angeles. Mr. Buffett, I've heard that one of your ways of focusing your energy is that you write down the 25 things you want to achieve, choose the top 5, and then avoid the bottom 20. I'm really curious how you came up with this and what other methods you have to prioritizing your desires.
Well, I'm actually more curious about how you came up with it, because it really isn't the case. It sounds like a very good method of operating, but it's much more disciplined than I actually am. If they stick fudge down in front of me, I eat it. I'm not thinking about 25 other choices. So I don't mean to. Charlie and I live very simple lives. We know what we do enjoy, and we now have the option of doing it pretty much. Charlie likes to design buildings. I mean, he's no longer a frustrated architect. He's a full-fledged architect now, and we both like to read a lot. But I've never made lists. I can't recall making a list in my life. But maybe I'll start. You've given me an idea. Thank you. Charlie?
Well, what's really interesting on this subject of Warren's operating methods, you can see happening here. We didn't know when we started out this modern psychological evidence to the effect that you shouldn't make a lot of important decisions when you're tired, and that making a lot of difficult decisions is tiring. And we didn't also know as well as we now do how helpful it is to be consuming caffeine and sugar when you're making important decisions. And what happens, of course, is that both Warren and I live entirely on autopilot in terms of the ordinary decisions of life. We're just totally habitual, so we don't waste any decision-making energy on that stuff, and we're ingesting caffeine and sugar. And it turns out, under the modern evidence, this is an ideal way to sit where Warren sits. And when he didn't know that, he just stumbled into it.
When we write our book on nutrition, it promises to be a huge seller.
I cannot remember an important decision that Warren has made when he was tired. He's never tired. He sleeps soundly, and he doesn't waste time thinking about what he's going to eat. As you say, he just eats what he's always eaten. No, his style turns out to be absolutely ideal for human cognition. It looks peculiar, but he stumbled into something very good.
No. You can write the foreword to my next book. Okay. Andrew.
Thank you. Mark Marzotto, Toronto, Canada. Bill Gross made recent comments that his generation of investors, yourselves included, owed a deal of their success to timing. Do you agree with Bill's comment? And do you think a similar opportunity will provide itself to today's investors? Thank you.
Yeah, there's no question that being born in the United States was a huge, huge, huge advantage to me. And as I pointed out in a recent article, being born male was a big advantage. I would not have had the same opportunities in the investment or in business world remotely that I've had if I'd been a female born in 1930. And the timing could have been a little better. Actually, my dad was a security salesman, and I was conceived in November 1929, and if you remember, the stocks had gone down dramatically at that time, and there really wasn't anybody to call on for my dad, and there wasn't any television at home or anything. So here I am, So I feel myself very lucky that the crash of 1929 came along. And that also provided a decade, more than a decade, of people who were very turned off. Well, it was a decade of terrible business for quite a while, and then a decade or more of people that were turned off on stocks, just as we sort of had a decade like that in the past decade going up to 2010 or so, a lot of people that had gotten turned off by stocks. So that was a favorable environment. But the United States itself was an incredibly favorable environment. If I'd been born 5 years earlier, I probably would have made more money. But if I'd been born 10 or 15 years later, I would have made probably less money. But I envy the baby that's being born today in the United States. I mean, I think on a probability basis, that's the luckiest individual that's ever been born. And I think that they will do very well in life in all kinds of ways on a probability basis, better than existed when I was born. And I think they'll have opportunities to do very well in the investment field. It may not be as good a field as it was for me starting in 1950, 51 or thereabouts. But it will be a very good field to operate in. The person that has a passion for investing, born today, coming of age 20 years from now, is likely, in my view, to do very well and to live far better than we live today, just as we live far better than John D. Rockefeller lived many years ago. Charlie?
Well, the competition was very weak in your early days. And I don't think the competition is as weak now. So I think, sure, we got advantages from timing. But I don't think that means there's nothing to be done ahead.
But Charlie, in 2008 and 9, there were all kinds of high IQ, highly experienced investment professionals. I mean, thousands and thousands and thousands of them. And you invested at the Daily Journal Company in some equities at X that are worth what, 3X or 4X now or something like that?
That's right.
Yeah, well, I call that opportunity, but maybe routine to him. But
yeah, but I sat for a lot of years before I did it.
But it still became available.
Oh, yes. But you were drowning in opportunities when I first knew you. You were not waiting for...
I wasn't drowning in money, unfortunately.
No, what you lacked was money.
Yeah. Well, now we got money and no ideas. Okay, station 10. Hi.
My name is Dexter Strang. I'm from Stafford, Virginia. I'm 30 years old, and I'm wondering what my life will be like in a few years, let alone 50 years from now. My question for both Mr. Buffett and Mr. Munger is, how do you think you've changed over the last 50 years? And if you could communicate to yourself 50 years ago, what would you tell him, one piece of advice, business or personal, and how would you do it in a way where your former self would actually heed it?
Charlie, I'll let you answer that. Incidentally, I'll trade you places, so don't worry about your future.
Yeah, we're basically so old-fashioned that we're boringly trite. We think you ought to keep plugging along and stay rational and stay energetic, and just all the old virtues still work.
But find what turns you on.
Yeah, you gotta work where you're turned on. I don't know about Warren, but I have never succeeded to any great extent in something I didn't like doing.
Charlie and I both started in the same grocery store, and neither one of us are in the grocery business.
We were not going to be promoted either, and even though you had the family name.
Yeah. Well. My grandfather was right, too. No, it's really, I mean, if you're lucky, and Charlie and I were lucky in this respect, we were lucky to be in this country to start with, but we found things we liked to do very early in life, and then we pushed very hard in doing those things, but we were enjoying it while we did it. We have had so much fun running Berkshire. I mean, it's almost sinful, but we were lucky to, my dad happened to be in a business that he didn't find very interesting, but I found very interesting, and so when I would go down on Saturday, there were a lot of books to read, and it just flowed from a very early age, and Charlie found it.
You found a way to atone for your sins and having so much fun. You're giving all the money back.
Well, yeah, but you give it all back whether you want to or not in the end.
No, that's true too.
We're now very close to noon. I promised 5 years ago, I wrote about 5 or 6 years ago about the inordinate costs that investors bear, and many investors bear in getting sold various types of products. And I talked about private equity and all kinds, and a whole variety of things. The investment world has been very good at extracting a very significant percentage of the returns that investors get for themselves. So I offered to bet anyone that wanted to step up to the plate that a group of hedge funds would not beat an unmanaged no-load index over a 10-year period. And I promised, and then I got a taker, and a very nice group of people. I like them, Ted Sidus and a group, and they took me up on this. So we each put about $350,000 or so into something where in 10 years it would, well, we put it in zero coupon treasuries, which would mature and be worth $1 million in 10 years. And I promised to report on the bet every year. And what we did this year, interest rates fell so far that our original $700,000 or so investment got to be worth like $950,000 just because the 5-year treasury got so low. So there was very little appreciation left into it between now and 5 years from now when it matures. So we sold the zero coupon treasuries and we bought Berkshire with the proceeds. And I guaranteed that it would be worth $1 million. Currently, it's worth about $1.2 million, so that the charities are benefiting to some extent. Now, Ted has one charity, which is a very worthwhile charity, and I have Girls Inc. of Omaha, which is a charity I selected. And we can put the figures up on there as to where we stand at the moment. The hedge funds got off to a fast start, and we're 13 points ahead of the index fund at the end of the first year. But the last 4 years, and these are fund to funds, so they really represent probably 200 or 300 maybe hedge funds underneath. But there's two levels of fees involved. There's the standard fees of the hedge funds, which probably many times are 2 and 20, but can be other things. And then there's the fee of the fund of funds on top of it. So we now are at the halfway point, and I'll keep reporting to you every year how we do. And if Berkshire does well, we'll have well over $1 million to distribute to one of two charities. You might enjoy going to a website called longbets.org. That's where they're the people that hold the money. And you will see that there are a number of propositions that people have wagered on. And the proponents and the opponent of every proposition give a short little description. Ted gave a description of why he thought he'd win. I gave a description of why I thought I'd win. But some of these are, I just can't resist pointing out a couple of them. You can see these on the web, but one of it is that a large collider will destroy the Earth in 10 years. Now, there's a $1,000 bet on that, but I'm not sure who will collect. I thought that was an interesting one. And there was one other, and then we'll go to lunch. But there are a number of these that are quite interesting. At least one human alive in the year 2000 will still be alive in 2150. Now, that's 148 years from when the bet was entered. There's a $2,000 bet on that. And I hope Charlie is in contention for being the winner of that one. Well, we'll take a 1-hour break for lunch. We'll be back here then, and we'll continue with your questions. Thank you.
Mae West once said, "The score never interested me, only the game." Are you at the point now where the game interests you more than the score? But before you answer the question, let me explain to you why I asked it. In the past, your research has been all-encompassing, whether measured in time devoted to selecting investments and acquisitions or the intensity of analysis. You were interested in the old days of knowing the slightest minutia about a company. You once said in characterizing Ben Rosner, quote, "Intensity is the price of excellence," close quotes. Your research style has seemed to morph over time from a sleuth-like analysis. American Express comes into mind when you hired Jonathan's dad, Henry Brandt. You and he conducted weeks of analysis and site visits and channel checks, not so much in the later investments. And as an example, you famously thought of making the Bank of America investment in your bathtub. There is an investment message of this transformation from being intense to less intense. Would you please explain the degree it has to do with the market, Berkshire's size, or some other factors?
Yeah, I think actually you have to love something to do well at it. And there may be exceptions on that, but it is an enormous advantage if you absolutely love what you're doing every minute of it. And that the nature of it is that intensity adds to your productivity. And I have every bit of the intensity, not manifested exactly the same way, but it's there every minute. I mean, I love thinking about Berkshire. I love thinking about its investments. I love thinking about its businesses. I love thinking about its managers. It's part of me. And it is true, you can't separate the game from the scorecard. I mean, so your scorecard is part of playing the game and loving the game. The proceeds are, to me, are unimportant, but the proceeds are part of the scorecard, so they come with a scorecard. But it's much more important. I mean, there's no question about it. I would feel the same way about Berkshire at this point if I didn't own a share of it, if I didn't get paid. I mean, it's what I like doing in life, and that's why I do it. So I don't think it's actually a correct observation, and Charlie can comment on this, to say that because we're doing things in a somewhat different way, that any of the intensity or the passion has been lost. There's nothing more fun for me than finding something new to add to Berkshire, and that was true 40 years ago. It's true now and be true 10 years from now, I hope. Charlie, how would you answer that?
Well, I think when you bought American Express for the first time, you didn't know that much about it. So naturally, you were digging in rather deeply. The second time you bought it, I remember you got on the golf course with Olson.
Frank Olson, yep.
And you just saw how he couldn't get rid of American Express if he wanted to. And then you bought it the second time. The research was still the first one was hard, and the second was easy.
It's all cumulative.
Yeah, it's cumulative, actually.
Yeah. And what I learned sitting with Lorimer Davidson on a Saturday at Geico in January of 1951 is still useful to me, and I don't have to learn it a second time. I can build on it, but that's one of the great things about investing. I mean, the universe, there's enough in it so that you can find lots of opportunities, but it's not like it's changing dramatically all the time. There's some things that may change, and we just don't play in that part of the game if we don't understand them. But what Charlie says is true. I didn't know a thing about American Express when the salad oil scandal hit in November of 1963. But I thought I saw an opportunity, so I learned a lot about it, and I went around to restaurants and talked to people about travel and entertainment cards, as they were called then. I learned about traveler's checks. I talked to banks, and I was absorbing some knowledge. And then, as Charlie said, when we were up at Prout's Neck playing golf with Frank Olson, and he was running the Hertz Corp, and he was telling me that there was no way in the world that he could get rid of American Express or even get them to cut their fees. That was my kind of business, and I knew enough to proceed to buy a fair amount of stock, and now we own whatever it is, probably 13% of the company or thereabouts, and they keep buying in their stock. We can't buy any more stock ourselves. I got asked that question in March of 2009 by Joe Kernan, why aren't you buying the stock of American Express? Well, it was a bank holding company, and we couldn't add a share. But they are doing it for us, and I love that. At Coca-Cola, at Wells Fargo, to a lesser degree, at IBM, at most of our companies, our interest in the company goes up every year because the companies are repurchasing shares, and they probably earn more money, so we got a double play going for us. The passion is not gone, I promise you. Station 1.
Hi, Warren and Charlie. My name is Vincent Wong from Seattle. When people analyze a stock, a lot of them look at quantitative metrics such as PE ratio, return on equity, debt to asset ratio, etc. So, Mr. Buffett, when you analyze a stock for purchase, what's your top 5 quantitative metrics that you look at? And what's your preferred number for each metric? Thank you.
Well, we're looking at quantitative and qualitative. We aren't looking at the aspects of a stock. We're looking at the aspects of a business. It's very important to have that mindset that we are buying businesses, whether we're buying 100 shares of something or whether we're buying the entire company. We always think of them as businesses. So when Charlie and I leaf through Value Line or look at annual reports that come across our desk or read the paper or whatever it may be, that for one thing we do have this cumulative knowledge of a good many industries and a good many companies, not all by a long shot. And different numbers are of different importance, or various numbers are of different importance depending on the kind of business. I mean, if you were a basketball coach, you know, you would, if you were walking down the street and some guy comes up that's 5'4" and says, you know, you ought to sign me up because you ought to see me handle the ball, you would probably have a certain prejudice against it, but there might be one player out there that it made sense on. But on balance, we would say, well, good luck, son, but, you know, we're looking for 7-footers, and then if we find 7-footers, we have to worry about whether we can get them halfway coordinated and keep them in school and a few things like that. But we see certain things that shout out to us, look further or think further. And over the years, we've accumulated this background of knowledge on various kinds of businesses. And we also have come up with the conclusion that we can't make an intelligent analysis about all kinds of businesses. And then usually some little fact slips into view that causes us to rethink something. It was mentioned how I got the idea about buying the Bank of America or making an offer to Bank of America on a preferred stock when I was in the bathtub, which is true. But the bathtub really was not the key factor. The truth is, I read a book more than 50 years ago called Biography of a Bank. It was a great book, and about APG and the history of the bank. And I have followed the Bank of America, and I've followed other banks, you know, for 50 years. Charlie and I have bought banks. We used to trudge around Chicago trying to buy more banks in the late 60s. And so we have certain things we think about in terms of a bank that are different than we think about when we're buying his car. And so there is not one size fits all. We think about when we're buying an insurance company. There's certain things we think about when we're buying a company dependent upon brands. Some brands travel very well, Coca-Cola being a terrific example, and some brands don't travel. And you know, we just keep learning about things like that. And then every now and then we find some opportunity. The Bank of America, whenever it was in 2011, was subject to a lot of rumors, terrible, I mean, lots of big short interest. Morale was terrible and everything else. It just struck me that an investment by Berkshire might be helpful to the bank and might make sense for us. And I'd never met Brian Moynihan at that point. Maybe I'd met him at some function, you know, some party or something, but I had no memory of it. And I didn't have his phone number, but I gave him a call. And things like that happen. And it's not because I calculate some precise PE ratio or price book value ratio or whatever it might be. It is because I have some idea of what the company might look like in 5 or 10 years, and I have a reasonable amount of confidence in that judgment, and there's a disparity in price and value, and it's big. Charlie, would you like to elaborate?
We don't know how to buy stocks just by looking at financial figures and making judgments based on ratios. We may be influenced a little by some of that data, but we need to know more about how the company actually functions. And anything a computer could be function to do in terms of screening, I know I never do it. Do you use a computer to screen anything?
No, I don't know how to.
No.
Bill's still trying to explain it to me. It's a little hard to be precise on it because we don't really use screens. On the other hand, we're screening everything. But it's not like we sit there and say, we want to look at things that are low to price to book value or low PEs or something of the sort. We are looking at businesses exactly like we'd look at them if somebody came in and offered us the entire business. And then we try to think, what is this place going to look like in 5 or 10 years, and how sure are we of it? And a lot of companies, we just don't know the answer to it. We do not know which auto company is going to, be knocking the ball out of the park 10 years from now, or which one's going to be hanging on by its fingernails. We've watched the auto business for 50 years. It's a very interesting business, but we don't know how to foresee the future well enough on something like that.
We think that the Burlington Northern will have a competitive advantage 15 years from now with a high degree of competence. We would never have that degree of competence about Apple, no matter what their financial statement showed. No, it's too hard.
Yeah, we don't know about an oil company 10 years from now, in terms of what the product will be selling for or anything. But I would say we're virtually 100% confident about a Burlington Northern or a Geico or some other companies that I won't name.
People with very high IQs who are good at math naturally look for a system where they can just look at the math and know what security to buy. It's not that easy. You really have to understand the company and its competitive position and the reasons why its competitive position is what it is. And that is often not disclosed by the math.
Yeah. It's not what I learned from Ben Graham, although the fundamentals of looking at stocks as businesses and the attitude toward the market and all that is absolutely still part of the catechism. But I don't know exactly how I would manage money if I was just trying to do it by the numbers that
you do it poorly.
Yeah. That takes care of that. Okay, Carol.
This question is from Benjamin Knoll of Greater Twin Cities United Way. Every time Bill Gross writes a new essay on the, quote, new normal, unquote, I get more depressed about the prospects for my retirement. Do you share his view that market returns in the next few decades will be much lower than in the past few? And should we expect Berkshire's future market returns to be greatly constrained, not only by its size, but also by much lower equity returns overall?
Yeah, Charlie and I don't pay any attention to macro forecasts. We have worked together now for 54 years, and I can't think of a time when we made a decision on a stock or on a company where a macro discussion, where we've talked about macro, and we don't know what things are going to look like in any precise way. And incidentally, naturally we think if we don't know, nobody else knows. That's a little conceit that we have, and so we, why spend time talking about something you really don't know anything about? People do it all the time, but it's not very productive. So we talk about the businesses, and I like Bill Gross. It sounds like Lloyd Benson, back in he's a friend of mine. But it doesn't make any difference to me what he thinks about the future. It doesn't make any difference to me, what any economist thinks about it. I have a general feeling that America will continue to work well. And I don't, that throughout my adult lifetime and before that, there's always been all kinds of opinions that, about what's going to happen this year, next year, anything like that, and nobody knows. What you do know, with a very high degree of certainty in my view, is that BNSF will be carrying more carloads 10 years from now, 20 years from now, that there will be no substitute for the service that they provide, that there will be 2 important railroads in the West and 2 important railroads in the East, and that they will have an asset that has incredible replacement value. Nobody could turn out something like it, and that they'll get paid fairly for what they do. And it's not very complicated. And to ignore what you know because of predictions about what you don't know or and what nobody else knows, in our view, is just plain silly. So we don't have anything against somebody talking about a new normal or an old normal or an in-between normal, but it doesn't mean anything to us. My own guess is that people will do very well owning good businesses if they don't pay too much for them, whether they hold them for 10 years or 20 years or 30 years. And if they try and time their purchases in some way by listening to forecasts about what's going to happen in business and try and buy and sell them, they're going to do very well for their broker and not so well for themselves. Charlie?
Yeah, but of course, Warren, we have a lot of money. We have to do something with it. So we're going to do our thing no matter what the external climate is. If you're a busy surgeon and trying to decide whether to work 2 more years before you retire, then you may be more interested, and rationally so, in the new normal. And I would personally advise the guy to work an extra couple of years. In other words, I kind of agree with Bill Gross.
What do you think the normal is?
Well, less than we've enjoyed in our lifetimes. The new normal.
What have we enjoyed in the last 10 years? I mean,
It hasn't been so bad.
No, and it hasn't been so,
But it's not nearly as good as it was in the first 30.
Yeah. And do you think it'll be worse than the average of the last 10 years?
I think that's quite a conceivable outcome.
Yeah. So take your pick. Okay. Jonathan?
And I'd also like to tell you that I think it would be great if you would publish the portfolio statements of the Buffett partnership years. I think there are a lot of small investors that would get a kick out of knowing, what you invested and how you went ahead and analyzed the companies. Thank you.
Yeah, well, Charlie ran something called Wheeler Munger, and his portfolio was even more interesting. So we'll start with you, Charlie. He ran a more concentrated portfolio than I did in those days.
Yeah, I don't think people would be greatly helped. You wouldn't recognize the names, most of them, of the early Buffett partnership. You'd recognize American Express, but they're rattle off some of the names.
Yeah, well, we can start with Mosaic Tile and
the map
Meadow River Coal and Land. there's hundreds of them. Flag Utica, Philadelphia Running Coal and Iron, you name it. I've literally owned, I bet I've owned 400 or 500 names at one time or another, but most of the money's been made in about 10 of them.
And I couldn't name 10 books either that I regard as that much better than the next 10. My mind is a blend of so many books I can't even sort it out anymore.
Yeah, well, The Intelligent Investor changed my life in terms of, I literally had read every book in the Omaha Public Library by the time I was 11 on the subject of investing. And there were a lot of books. And there were technical books, Edwards and McGee. I mean, that was a classic in those days. And a whole bunch of them, Garfield Drew. But, and I enjoyed reading them a lot. Some of them I read more than once. But I never developed a philosophy about it. I enjoyed it. I charted stocks. I did all that sort of thing. Graham's book gave me a philosophy, a bedrock philosophy on investing that made sense. I mean, he taught me how to think about a stock. He taught me how to think about the stock market. And he taught me that the market was there, not to instruct me, but to serve me. And he used that famous Mr. Market example. He taught me to think about stocks as pieces of businesses rather than ticker symbols or things that you could charter or something of the sort. And so it was that philosophy, and in some way further influenced by Phil Fisher's book. And Phil Fisher was just telling me the same thing that Charlie was telling me, which was that it's very important to get into a business that had fundamentally good economics and one that you could ride with for decades rather than one where you had to go from flower to flower every day. And that philosophy has carried me along. Now, I've learned different ways of applying it over the years, but it's the way I think about businesses now. I have not found any aspect of that bedrock philosophy that has flaws in it. You have to learn how to apply it in different ways. So those are the books that influenced me. And of course, in other arenas, Charlie's probably read more biography than anybody that I know of. And I like to read a lot of it. We just got through reading the Joe Kennedy biography. You've read that, haven't you, now, Charlie?
Yeah.
I'm not sure you want to emulate everything he did, but it's still interesting reading. We read for the enjoyment of it. I mean, it's been enormously beneficial to us, but the reason we read is that it's fun, and it's still fun. And on top of it, we have gotten very substantial benefits from it. My life would have been different if Ben Graham hadn't gone to the trouble of writing a book, which he had no financial need to do at all. I would have had a very different life.
Ben Sauer from Shreveport, Louisiana. Could you be more specific about what factors you considered when determining what a fair price was for an acquisition such as Heinz? And also, what sources do you use to make judgments about major changes that will affect an industry?
Yeah, well, we usually feel we're paying too much, isn't that right, Charlie? But we find the business so compelling, and the management or our associates so compelling that we gag and we get there on the price. But there is no mathematical, perfect mathematical formula. Looking back, when we bought wonderful businesses that turned out to continue to be wonderful, we could have paid significantly more money, and they still would have been great business decisions. But you never know 100% for sure, and so it isn't as precise as you might think. Generally speaking, if you get a chance to buy a wonderful business, and by that I mean one that has economic characteristics that lead you to believe with a high degree of certainty that they will be earning unusual returns on capital over time, unusually high. And better yet, if they get the chance to employ more capital at high rates of return. That's the best of all businesses. And you probably should stretch a little. Charlie and I have had several conversations where we were looking at a business which we liked, and we're sort of gagging at the price, and Charlie or I will say, let's do it, even though it kind of kills us to pay that last 5%. We did that with See's Candy. Charlie was the one that said, for God's sakes, Warren, write the check. I was the one that was suffering. But it's happened quite a few times, hasn't it, Charlie?
It almost always happens. Modern prices are not cheap.
No. And great businesses, you're not going to find lots of them, and you're not going to get the opportunity to buy them. And although you do in the market, the stock market will offer you opportunities for profit percentage-wise that you'll never see in terms of negotiated purchase of business. A negotiated purchase of a business, you're almost always dealing with someone that has the option of either selling or not selling, and can sort of pick the time when they decide to sell and all of that sort of thing. In stock markets, it's an auction market. Crazy things can happen. You can have, some technological blip that will cause a flash crash or something, and the world really hasn't changed at all. But all kinds of selling mechanisms are tripped off and that sort of thing. So you will see opportunities in the stock market that you'll never really get in the business market. But what we really like buying businesses to hold and keep. We like buying cheap marketable securities too, but particularly when you've got lots of cash coming in and you're going to continue to have lots of cash coming in, you really want to deploy it in great businesses that you can own forever. Charlie, anything?
No, we're sort of in a different mode now. And that has a great lesson in that if we'd kept our earlier modes, if we'd never learned, we wouldn't have done very well. The game of life is a game of everlasting learning. At least it is if you want to win.
We want to win. Carol?
Derek Foster, Ottawa, Canada. First of all, thank you, Warren, for sharing all your information. You've changed my life. I took finance in university, couldn't understand Greek formulas, but now I can invest reasonably well. My question to you is, in the past, you've said for an investor, for 99% of investors, you should simply stick money in an index fund and let it go and don't worry about it. Those 1% of investors, choose your best 5 stocks and put a substantial amount of money in it. I'm just wondering, how about a strategy of perhaps buying 20 of the best stocks in America, Procter & Gamble, Coca-Cola, Johnson & Johnson, whatever, the companies that have been around for centuries or a century or decades or whatever, and just leaving it at that? Do you think that would outperform an index fund over the long term? And I want Charlie's opinion as well.
Well, it's a little bit of, I don't know whether you're saying the 20 largest companies, the 20 best, you might get different thoughts from different people on what they are. But I think probably the 20 you would pick would virtually match the results of an index fund. Who knows exactly which ones would be the best. But the real distinction, and Graham made this in his book, basically, is between the person who is going to spend an appreciable amount of time becoming something of an expert on businesses, because that's what stocks are, or the person who is going to be busy with another profession, wants to own equities, and actually will do very well in equities. But the real problem they have is that they may tend to get excited about stocks at the wrong time. Really, the idea of buying an index fund over time is not to buy stocks at the right time or the right stocks, it's to avoid buying them at the wrong time, the wrong stocks. So equities will do well over time, and you just have to avoid getting excited when other people are excited, or getting excited about certain industries when other people are. Trying to behave like a professional when you aren't spending the time and bringing what's needed to the game to be a professional. And if you're an amateur investor, there's nothing wrong with being an amateur investor. And you've got a very logical, profitable course of action available to you, and that is simply to buy into American business in a broadly diversified way and put your money in over time. So I would say your group of 20 will probably match an index fund, and you'll probably do well in that, and you will do well in an index fund. Charlie?
Well, I've got nothing to add, but I do think it's that knowing the edge of your own competency is very important. If you think you know a lot more than you do, well, you're really asking for a lot of trouble.
Yeah, and that's true outside of investments,
yes.
too.
Yeah. Works particularly well in matrimony.
Do you want to give any other advice on this subject?
Brandon from Los Angeles. If I'm in my 20s and I'm starting a partnership, what advice do you have about getting people to put in money before I have a track record as a solo investor?
Well, you haven't sold me. No, I don't. I think people should be quite cautious about investing money with other people, even when they have a track record. Incidentally, there are a lot of track records that don't mean much. But overall, I would advise any young person that wants to manage money and wants to attract money later on to start developing an audited track record as early as they can. I mean, it was far from the sole reason that we hired Todd and Ted. But we certainly looked at their record. And we looked at a record that we both believed and could understand, because we see a lot of records that we don't really think mean much. I mean, if you get, if you have a coin flipping contest, as I wrote, some years ago, and you get 310 million orangutans out there, and they all flip coins, and they flip them 10 times, you will, instead of having 300 million left, you'll have 300,000 roughly left that'll flip 10 times in a row successfully. And those orangutans will probably go around trying to attract a lot of money to back them in future coin flipping contests. But, so it's our job when we hire somebody to manage money to figure out whether they've been lucky coin flippers or whether they really know what they're doing.
When you had his problem, didn't you scrape together about $100,000 from a loving family?
Yeah, well, I hope they kept loving me after they gave me the money. That was it was very slow, and it should have been very slow. As Charlie has pointed out, some people thought I was running a Ponzi scheme probably there, and other people may not have thought it, but they thought it was to their advantage to sort of scare people because they were selling investments in Omaha. But to attract money, you should deserve money, and you should develop a record over time that does it, and then you should be able to explain to people why that record is a product of sound thinking rather than simply being in tune with the trend or simply just being lucky. Charlie? You're starting today and you're 25 years old. How do you attract money?
Friends and family, or people whose trust they've already earned in some other way. So it's hard to do when you're young, and that's why people start so small.
And a relatively few will be successful.
That's right, too.
Yeah. A great many will be successful and make, we had the hedge fund record here. And during that time, the hedge fund managers have probably made a very considerable amount of money. As I pointed out, Todd and Ted, working under a 2 and 20 arrangement, if they put the money in a hole in the ground, would make $120 million each this year. So it's not exactly an arrangement that you don't want to think about a little bit before you engage in it.
The arithmetic attracts many of the wrong sort of people.
Naturally, we thought we were exceptions.
Yes.
Andrew?
Chris Yu from Tokyo, Japan. Can you talk a little bit more about the IBM investment? Where do you see the moat for that business? And just in the spirit of full disclosure, I worked for Microsoft.
Yeah. Was your question, what was the moat around which business?
IBM.
Oh, IBM. Well, I would say that I do not understand the moat around an IBM as well as I understand the moat around the Coca-Cola. I think I have some understanding of it, but I feel I would have more conviction about the moat around a Coca-Cola or a Wrigley or a Heinz for that matter than an IBM. But I feel good enough about IBM that we put a considerable amount of money in it, and there's nothing that precludes both Microsoft, which you mentioned, and IBM being successful. In fact, I hope they both are. I've got enough conviction about IBM's position that we took a very large position. I like their financial policies. I think the odds are good that their position is maintained in a strong way over time. But I don't feel the same degree of conviction about that as I do about the BNSF Railroad. I mean, it's very hard for me to think of anything that can go wrong with BNSF. I can think of some things that can go wrong with IBM. They incidentally have a very large pension obligation. Now, they have a large pension fund too, but you're talking $75 or $80 billion of assets and liabilities that, it is a big annuity company on the side, and you can have balls can take funny bounces in the annuity field. I would rather they didn't have that, but that is a fact that I take into consideration when I buy it. They show the assets and liabilities as being roughly equal, but the liabilities are a lot more certain than the assets over time. Charlie?
Hello, my name is Stuart Kay, and I work in Stamford, Connecticut. Earlier in the meeting, you said when reading over financial statements, you identified companies you were virtually certain were frauds. What was it in those financial statements that you saw that made you be so certain they were frauds?
Well, it varies just enormously over the years, but there are, we can't identify 100% of the frauds or 90% or 80%, but there's certain ones that jump out to you. Just people give themselves away a lot too. I mean, in poker they talk about tells, and Charlie and I have bought a lot of businesses, and it's very important when we buy those businesses that we assess the individuals that we're buying from with some degree of accuracy, because they hand us the stock certificate and we hand them a lot of money, and then we count on them to run the business with as much enthusiasm after they have the money as they did before. And so we are assessing people, and we don't think we can assess everyone accurately. We just have to be right about the ones where we make an affirmative decision. And those decisions have not always been perfect, but they've been pretty good, and I would say they've probably gotten a little bit better even as the years has passed. Similarly, in looking at financial statements, for example, in the insurance field, we've seen some frauds, and you can see things being done with loss reserves occasionally. We saw it back in, I won't name any names, unlike Charlie. We'll call them company A's and B's instead of naming names. But you would see companies that when they were offering stock to the public, the year or two before that, the reserves would go down very suspiciously, or even when they were selling them to other insurance companies. If they were buying in stock, they might be building the reserves. But there's a million different ways, and I don't claim I know all the ways, obviously, but I have seen enough situations over the years, and I've seen how promoters act, and you can spot certain people who are one way or another playing games with the numbers. They give themselves away, but I can't give you a checklist of 40 items or something of the sort that you look for in the balance sheet or the income account or the footnotes. Charlie, can you help him anymore?
Sometimes it's pretty obvious. I once was introduced by Warren, of all people, by accident, to a man who wanted to sell us a fire insurance company. And among the first things he said with a thick accent, from Eastern Europe, I think.
Don't name countries.
And I don't remember the country.
Good.